In this video, we're going to cover HELOCs and second lien mortgage options, and more importantly, when each one actually makes sense to use. HELOC stands for Home Equity Line of Credit. A HELOC is a revolving line of credit secured by the equity in your home. It allows you to borrow funds as needed and reuse the available credit during the draw period. The most common structure is a 3 to 5 year draw period where minimum payments are typically interest only, followed by a repayment period where the balance is now fully amortized for the remainder of the term. HELOCs function similarly to a credit card, but with much lower interest rates because they're secured by your property. Key features include variable interest rates, usually tied to the prime rate or federal funds rate, lower rates than credit cards, and higher rates than first mortgages. Because of this flexibility, HELOCs are often best used as an emergency liquidity backup, short-term financing, or tool for home renovations. Many HELOCs provide a debit-style card, check writing capabilities, and online transfers directly to your bank account. Most HELOC programs cap the combined loan-to-value, or CLTV, your first mortgage, plus the HELOC at around 85% of your home's current value. Depending on the lender, there may be a minimum line amount, and there may be a minimum initial draw requirement. Since early payments are usually interest only, HELOCs often offer much lower initial payments compared to fully amortized loans. An alternative to a HELOC is a traditional second mortgage, often structured as a 20 or 30-year fixed-rate loan. The key differences when comparing to a HELOC are funds are taken out in a lump sum, payments are fully amortized from the get-go, the interest rate is fixed, and once the balance is paid down, you cannot reborrow funds. Because payments are amortized, the monthly payment is usually higher than a HELOC, but you get long-term payment stability. This option works well for debt consolidation, large home renovations, or situations where you don't expect to pay the balance down quickly. Many homeowners locked in historically low first mortgage rates in the past few years. Refinancing that first mortgage just to access equity often doesn't make financial sense. HELOCs and second liens allow homeowners to access equity, keep their existing low-rate first mortgage, and avoid resetting their loan term. That said, these options are not automatically better than a cash-out refinance. While preserving a low first mortgage rate feels good, it's still important to compare the total cost. In some cases, especially with debt consolidation, a traditional cash-out refinance may result in a lower combined monthly payment, reduce total interest paid over time, and simplify finances into a single loan. The right choice depends on how long you plan to carry the balance, your ability to pay it down, and rate structure and market conditions. HELOCs and second lien mortgages are powerful tools, but only when used intentionally. They offer flexibility, liquidity, and alternatives to refinancing, but they also come with variable rates, added complexity, and long-term considerations. If you found this video helpful, please subscribe and follow us on social media for more clear, practical mortgage education. Thanks for watching.